Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore, and in this video we will look at what are the recent amendments which have been notified both under IFRS and Ind AS in respect of sale and leaseback transactions. We will see the genesis, why those amendments were required, and what the guidance have been given by the standard setters both under IFRS and Ind AS. So just to set the context, to understand what was the genesis, what caused the amendment to be notified for the standards. So what is the issue? This is the familiar chart which we have seen in the previous videos as well. So we'll continue with the same thing, and we will look at that. We know what is the sale and leaseback transaction is, but then what caused, what led to standard setters to notify the amendment? This was the trigger. So the trigger for the recent amendment to the sale and leaseback transactions related guidance is because questions were raised by various stakeholders that how they need to measure the ROU asset and lease liability on initial recognition in a sale and leaseback transactions when the variable lease payments are involved in the leaseback transaction. If you remember one of the previous, in the two videos which we have said that this is a sale transaction and in return you have a leaseback transaction. But the lease payments which this airline company was making to the counterparty was a fixed amount. In the previous two case studies, it was 1,20,000 per annum, fixed amount. The question which have been raised by the various stakeholders that if it is not fixed, let us say there are certain variable lease payment also, then how do you deal with it? The reason is this, that the question was raised that if the lease payment in a leaseback depends on, let us say, future sale of the seller lessee, then in that case, is it acceptable for the lessee, which is this guy, to measure the ROU asset and the lease liability at zero? Why so? I'll explain this just now in this slide itself. And therefore, recognize full gain or losses on sale of the underlying transaction. Why this question was raised? Let us see this. What is the guidance in the standard? Why this question was raised? Look at it. This is what you see here. This is paragraph 27 of Ind AS 116 and IFRS 16. So the way the definition of lease payment under paragraph 27 of both IFRS 16 and Ind AS 116 is that lease payment include only that variable component, only certain variable lease payments which are linked either to the index or to the rate. So for example, if I say that the lease rental is, let us say, linked to the inflation rate, right? If that be the case, then that lease rental is part of the calculations and the quantification of lease payment. That means if the variable payment is not linked to index or a rate, so for example, if I say, let's say in this case, that how many people have traveled using the aircraft, your turnover into 2% you give me the lease payment apart from, let us say, a fixed amount. Then in that case, this 2% is not linked to any rate or interest, a rate or a index. It is linked to the revenue. Going by the requirement in paragraph 27, that 2% revenue based variable amount should not be included in the lease payments. So the question which was asked, is it okay to do that? That you completely ignore that 2% variable lease payments based on the revenue, for example, in this case. Now that forced the standard setters to relook at the guidance, and therefore the response by the standard setters under IFRS world was this. Accordingly, the IASB, the International Accounting Standards Board, issued amendment to IFRS 16, which supplements the requirement of accounting treatment for sale and leaseback, which was already there, and they revised the examples in the standard IFRS 16 to illustrate how to apply the board's new guidance when the leaseback transaction involves variable lease payments. And similar guidance was issued under Ind AS framework by the MCA in September 2024, under Ind AS world as well by this amendment. So this is the genesis of the amendment. Now let's move forward and see what is the guidance provided, what the amendment tells you, what you have to do. Let us see this. So I have brought forward, this is the requirement in paragraph 27 related to lease payment. This is the general requirement. Now, what the clarification has been provided in the amendment, what the amendment says. The amendment now introduces a new accounting model for variable lease payments, including those variable payment which do not depend upon rate or index and require the seller lessee to reassess and potentially restate even the prior sale and leaseback transactions which they have entered into in the past, even before this amendment has come into picture. If those sale and leaseback transactions did include the variable lease payments, which was not considered the way the amendment requires you. Let me summarize it one more time. What the standard tells you, the amendment tells you, is that the new requirement, the core requirement of the amendment is that even if the variable lease payments in a leaseback is not linked to the rate or index, you still need to consider that at initial recognition. Read it here. So the core requirement under the amendment is that on initial recognition, when the leaseback transaction is initially recorded, at that time, the seller lessee, this guy, when they are setting up the lease liability under the leaseback, they are required to include the variable lease payment in the lease liability, even if that variable lease payment is not linked to index or the rate. Now, this change, this amendment is a significant departure from the general model, because this is what is the general model. General model says only such variable lease payments you will include in the lease payments which are based on rate or index. But here you have a departure. They are saying now under the amendment that if you are entering into a sale and leaseback transaction, then variable lease payment, whether on account of or whether linked to index or rate or otherwise, say revenue based, everything need to be incorporated as an exception or as a departure from the normal requirement. So this represents a significant departure from the general rule. That means at initial recognition, the seller lessee has to incorporate and bake in the variable lease payments when those relate to sale and leaseback. Right? Further, even after this amendment, as I already mentioned, this requirement is only on initial recognition. So the seller lessee will continue to apply the general requirements in the subsequent measurement. Subsequent measurement of the lease liability will continue to be based on the general requirements in the standard. So what this amendment brings in? The amendment brings in this new guidance, wherein only at initial recognition, all variable lease payments, whether linked to index or not, or otherwise, everything need to be considered at the time of initial recognition. And we will see a case study to explain this concept also. In fact, there are two approaches which are there. We will in this video, we will look at one of the approach. And in the next video, when we conclude our discussion on this amendment, I will look at the second approach, and also we will give some of the impact arising out of this amendment for various, preparers of financial statements. So accordingly, the recent amendment to both IFRS 16 and 116, how does it impact a seller lessee? So due to this amendment, the seller lessee, it will get impacted because it will need to account for variable lease payment on initial recognition, whether linked to rate or index or any other factor like your revenue or usage. Still, you have to bake in that. That is the sum and substance of the amendment. So what this amendment practically, from a practical standpoint, what it translates into. Let's see this. So after this amendment, because of the guidance which we saw on the last slide, the seller lessee, this guy, will be required on initial recognition. Then when it is measuring the lease liability, they need to include the variable lease payment when computing the lease liability arising on sale and leaseback. Second point. Therefore, when they are computing this lease liability for this purpose, the seller lessee may adopt different approaches. The two most commonly used approach would be let us say the same example where if we are saying that the lease payment because of the leaseback, okay, in the leaseback, the lease payment under the leaseback consists of two parts: fixed component plus a variable component based on revenue. So let's say 3% of the revenue is something which you need to pay as the variable lease payment. Then in that case, there are two alternative approaches which the amendment talks about. It says, assume scenario 1 or approach 1 wherein you are able to estimate the revenue for the period of sublease. No, not sublease, the sale and leaseback. So if this is the time on which you are entering into the sale transaction, and then you are having the sale and leaseback. Now, assume that this sale and leaseback period is 5 years, for example. Now, during this 5 period, your expected revenue, if you are able to estimate, you will apply approach 1. But if you are not able to estimate revenue, which is in the future, those 5 years, then you will apply approach 2. So in approach 1, you are able to estimate the lease payments because you are able to estimate the variability. Let's say in my example, the revenue, the future revenue, you are able to estimate at the commencement date of the sale and leaseback. Then you will apply approach 1. But if you are not, then you will apply approach 2. I'll explain and illustrate both these approaches. In this video, we will restrict it to approach 1, and this I will cover in the next video, just to ensure that the video does not become too long. Now, further, as I already mentioned, after the initial recognition, the seller lessee, this guy, will apply the general requirements for subsequent accounting of lease liability, and hence it will not recognize any gain or loss relating to right of use it retains. I'll explain this when we go to the case study. And any difference, because see what happens in approach 1, we said that the seller lessee is able to estimate the future revenue, and therefore they are able to estimate the variable lease payments. So any difference between the actual versus what you estimated, that is taken to P&L as and when that difference arises. So in my example, you entered into the next 5-year period. Assume you estimated, the estimate was 10 and your actual is 12. The delta of 2 will be taken to P&L in this period. That is what essentially this point tells you. All of these points are illustrated in the next case study. Let's see this. We will explain. I'll use the similar chart which we saw in the earlier 2 videos, and we will explain approach 1, what the amendment under approach 1 talks about. So similar example here. Rather than building, here you have a machine. So you have similar example which we saw in the last two videos also. You have a machine. Citicorp is the seller lessee, he is the buyer lessor. They sell this at the fair value of 25 lakhs. So sale consideration is 25 lakhs. Fair value of the machine is also 25 lakhs. What is the carrying amount? Carrying amount of the machine is 20 lakhs. Sale transfer constitutes a sale as under Ind AS 115 and IFRS 15. Then leaseback period is 5 years. And in this leaseback period of 5 years, there are two components. For the use of this machine, this seller lessee will pay 50,000 rupees of fixed lease payment payable at the end of the year. However, apart from this fixed, there is also a variable payment. In this example, considered at 3% of the revenue generated from the use of this machine. So if this machine generates revenue of 100, 3% of that would be payable as part of the lease payment. This is a variable lease payment. And as you can see, this is not based on the rate or an index like inflation rate or any index. This variable lease payment is purely on account of the revenue generated from this particular machine. Therefore, what the amendment explains you, let's see this. Okay, now the amendment tells you here one more additional fact pattern given in the case study is that your interest rate implicit in the lease is 4%. That is what you will be used as a discounting rate. And once this guy has given the machine back on sublease, this seller lessee expects to consume the machine, the ROU asset, the economic life of this evenly over the 5-year lease term. This is the additional information given to you in this particular case study. Now, given this framework, how do you apply approach 1? Approach 1, to illustrate approach 1, we have seen what we have said, that the standard as amended by the recent amendment requires you to bake in even this number also at the time of initial recognition. Let us assume that, or at the initial recognition, assume that this Citicorp is able to estimate what would be your revenue in this 5-year of sellback period, sale and leaseback period. So, what they are estimating that in the first year after leaseback, revenue from this machine, use of the machine will be 15 lakhs, 16 lakhs, 16.5 lakhs, 17 lakhs, and 18 lakhs. Now, that means 3% of each of these number would be the estimated variable lease payments. Because you are able to estimate the revenue, then 3% of the revenue is your estimated variable payments at the start of the sale and leaseback arrangement. So if this happens, how? The question is that the accounting for such sale and leaseback transaction need to happen after the amendment has come into picture. So post-amendment, how do you do the accounting? As I said, post-amendment, Citicorp, when estimating the lease payment, will also have to include this, which is in departure from the general rule, wherein variability, which is not based on index or rate, is not to be reckoned. But here it will be reckoned, it will be considered as given in the amendment. So let us see the calculations now. Since the seller lessee is required to measure the ROU asset arising on the leaseback, which we have already seen in the last two videos also, as a percentage of carrying amount of the asset, which relates to the right of use which you have retained. So therefore, in this case, you have to compute it, which is required under paragraph 100A. Unfortunately, however, the standard do not prescribe any method. If you remember the last two videos, what did we do? How did we compute it? How much is the percentage retained? How much is the percentage which you have transferred? What did we say? What is your total present value of the lease liability? And how much is something which you, out of the total fair value, how much you have assumed back? And the difference of these was something which you have transferred. Similar concept can be applied. But that is one of the method by which you will compute how much you have retained, how much you have transferred. So that's what I said. One possible method to compute the ROU retained is to compare the present value of the expected lease payments. Now here the difference is including variable lease payment, which is served as an exception to the general requirement. In general, this should not have been included. But because of the amendment and the clarification given by the standard setters, you will include even this variable payment also as part of your present value of your lease liability and compare that with the fair value of the asset. So the principle is the same, what we saw in the last two videos. Just that here you will include even this also as a departure from the regular requirement. Right. So with that said, now let us see the calculations. So as we have seen in the case study tells you, you have a 5-year of leaseback. And in this, fixed payment is 50,000 per annum. The revenue is able to be estimated. This is the estimated revenue for each of the 5-year of sublease, revised sublease, sale and leaseback. Then 3% of this is your expected variable lease payments. So what is your total lease payment? 50,000 plus 40,000. Basically, column 1 and column 4 is your total lease payment including the variable lease payment. In year number 1, 50,000 plus 45,000, aggregating to 95,000. 50,000 plus 48,000, 98,000. Likewise, this is the stream of lease payments which you have estimated considering even the expected variable lease payments. Now, you have to arrive at the present value, this present value, you have to discount it. Discount rate is given in this at 4% in this case study. So basically, this cash flow stream, which is there in column 5, need to be discounted at 4%. These are the PV factors at 4%. And therefore, your discounted value of this cash flow stream of 4,97,500 will be 4,42,223. So basically, this 442 is this first bullet point. This you have to compare with the fair value of the asset on the date of sale. And then you will compute how much you have transferred. So in this case, ROU, how much you have retained? How much ROU you have retained? ROU you have retained is, this is the amount which you have assumed back, 442, as a percentage of fair value of 25 lakhs. So, what is the ROU you have retained? You have retained 17.69%, computed as, this is the leaseback liability which you have assumed back as a percentage of the fair value of 25 lakhs. Right? So this is what, so as a corollary, if you have retained 17.69, 100% minus 17.69 is what you have transferred. That's what if you see here on the right hand side. We say, if you have retained this much, that means you have transferred 82.31%, the balance amount, balance percentage. You have transferred to the counterparty. Then in that case, how the journal entry will be? Same concept which we saw in the earlier two videos. You will receive cash of 25 lakhs, sale proceeds, which is the sale consideration equal to the fair value of the machine in this case. You have to de-recognize the machine at the carrying amount of 20 lakhs, which is here. Sale proceeds of 25 lakhs, debit, credit machine, de-recognition at 20 lakhs. What next? Lease liability. What is the lease liability you have assumed? Now this number will be coming from here. 442,223. As I already mentioned repeatedly, this 442 also includes the effect of expected future variable lease payments based on the future revenue which you have forecasted. You are able to estimate it. So Third component is your lease liability. Debit cash, credit lease, credit machine, credit lease liability. Then gain or loss. And ROU. What is the ROU asset? ROU asset to be debited, as we have seen earlier also. How much you have retained? ROU, you have retained 17.69%. Therefore, the carrying amount of 20 lakhs, 17.69% of 20 lakhs is your ROU asset. And the balancing amount would be gain or loss on transfer of the machine. Either a balancing figure, you can either compute this as a balancing figure or this as a balancing figure. Because ultimately, how much is your gain or loss? It is nothing but what you have transferred, 82.31% of profit of 5 lakhs. 25 lakhs sale proceeds against the 20 lakhs carrying amount. So 5 lakhs is your total gain. 82.31% is you have transferred to the counterparty. So 81.31% of 5 lakhs, you will be able to recognize profit. So either you compute this number first and ROU is the balancing number, or I've already given you the calculations. You can very much calculate all the numbers also. Cash, ROU, 17.69% of the carrying amount. Machine, carrying amount gets de-recognized. Lease liability, including the component variable lease payment, gets credited, and the gain or loss to the extent what you have transferred, 82.31% of the total gain of 5 lakh rupees. This is on initial recognition. When you have estimated that is my total lease payment, consisting of this and this. What about subsequent measurement? This is initial measurement. What about subsequently? Later on, in subsequent period, your estimated number may not turn out to be correct. May be different. Your actual numbers may be different than what you have estimated. So let us see. What about subsequent measurement? What the amendment explains under approach 1. So in this case, as we have mentioned earlier, the amendment does not change the subsequent measurement requirement of the standard. Accordingly, an entity will need to apply what is known as expected lease payment, what we have already computed in the last slide at the date of commencement. That approach you need to apply. So what do you have to do? So by applying, I brought forward the calculations, what we have seen in the last slide. This is what you have to do. So in this case, by applying paragraph 102A, capital A of the standard, the seller lessee, this guy, the seller lessee, the seller lessee will determine the lease payment to reflect the expected lease payment. What is the expected lease payment on commencement date? Is 442, which is discounted at 4% rate, which results in the carrying value of the lease liability at 442. What does it mean? Let's simply look at it. So what happens? Now, you have in subsequent measurement, initially you have said my lease liability is 442. So you develop the lease amortization table with the opening balance of 442,223. Then you do the unwinding at 4%, the discount rate of 4%. You do the unwinding. So 4% of this opening balance is your interest accrual. How much you will pay? The expected amount of this 95,000, all of these which is listed here. The expected payment. That will be your closing liability. This closing becomes opening. Then again 4% of second year's opening is your interest accrual. Payment comes from the expected payout in the table which we have already computed. Same way you compute your amortization table, and obviously you are using the same discount rate. So at the end of the 5th year, it will become 0. But problem is this, that this payment need not be equal to what your actual payment is, because this estimate may be different. So what the standard tells you, follow the regular requirement. Therefore, any difference which you have between the payments made, the actual payment made, and the estimated payment is taken to P&L. For example, let me clear this. For example, if the seller lessee pays in the second year, instead of 98,000, second year estimated payment was 98,000, which is also reflected here. But assume your revenue was more than what you anticipated, and therefore, if your actual payout is 1,03,000, there is an extra which you are paying to the extent of 5,000 rupees. 1,03,000 minus 98. That 5,000 will be taken to P&L. This 5,000, the incremental amount will be taken to P&L. Had it been ulta, let us say, instead of 103, okay, is this number would have been, let's say, 92K. Your revenue would have been actually, let's say the actual revenue was lesser than what you forecasted. Then the difference of 98 minus 92, that will also be taken to P&L. This was a P&L charge, that will be a credit to P&L. 6K would have been credit to P&L. Right? Now, what about depreciation? Because the case study told you that the seller, lessee, expects that the uniform value will be obtained from the use of the asset. So therefore, if you look at in the last slide, when we have prepared the journal entries, we have computed. Let me go there. We have computed the ROU set 353. If you see if you see the ROU set, we have computed 353,778. Now this 353,778 will be amortized on a SLM basis over the 5-year period, because the benefit of this ROU set is being availed by the entity on a uniform basis, and therefore this divided by 5 would be your annual depreciation charge on the ROU asset. Therefore, if you record the depreciation, basically it will nullify to 0 at the end of 5 years. So with this, we have, just to recap, we have covered the amendment to IFRS 16 and Ind AS 116, which relates to sale and leaseback. We have looked at that there is a departure from the general rule, and variable lease payments need to be included as part of initial recognition if you have sale and leaseback transaction, and subsequent accounting will follow the general rule. Now, we have only looked at approach 1, where the seller lessee was able to estimate what would be his revenue and accordingly what would have been the expected lease payment. But what happens if this entity is not able to estimate this amount, the revenue? That means you can't estimate this. So in that circumstances, how should you deal with this amendment is something which is given in approach 2. So that approach 2 plus what are the transition requirement, what is the impact of this assessment potentially on the existing reporters who have already recorded in the past sale and leaseback transaction which had variability component also. All of this is something which will continue in the next week's video, and we will conclude our discussion on the amendment to sale and leaseback. I hope you are liking the deliberation which we are covered on this channel. Okay, I hope that is something which is helpful to all of you. If it does, please help the channel and me personally in terms of subscribing, circulating it to anyone who is in need of this kind of a video. This is the link of my YouTube channel. Some of the content which are there on my channel, various aspects, various areas, not just accounting. Feel free, and I will continue to remain engaged with all of you. We will conclude our discussion on this in the next week. I take a pause. Thank you very much for paying attention. Bye. Bye for now.